So market-based valuation is based on a very simple idea. The idea is that similar stocks should be traded at same multiple. So if my peer companies are traded at, say, for example, 20 multiple of their earnings, in that case, if I provide, say, $2 earnings, I should be, or my stock should be traded at 2 multiplied by 20 or equal to 40 price. If I see that my stock is traded at a multiple 16, while my peer companies are traded at 20 multiple, I consider that my stock is relatively undervalued. Alternatively, if I see that my peers are trading at 20 multiple, but my stock is trading at 25 multiple, I consider my stock is relatively overvalued. So note the word relatively. So the valuation is the relative valuation. You probably can recall we have seen two flavors of valuation approaches. One is absolute, another one is relative. So out of the relative, the market-based valuation is one of the most prominent categories. And when we conclude the result of relative-based valuation, we should mention this, that this stock is relatively overvalued or this stock is relatively undervalued. So as I mentioned that we will compare with someone or we'll compare with peer. So ideally speaking, we compare with something called, which is known as the benchmark value. So with which we will compare our multiple. So the issue is that from where we get this benchmark value. So there are primarily four sources from where we can get the benchmark value. You probably can recall I mentioned 20 from my peer companies. So this is one sources that I will mention very first. So industry peers. So the idea is that the companies who are doing very close business with me, or my product is very close to the product of those companies. In that case, those companies are my peer companies. Now, if you think of the companies like, say, Bangladesh Edible Oils Limited, so which produces the, the vegetable oil. So in that case, who are the companies with which you can consider that this company can be comparable? So think of other vegetable oil producing companies like the City Group, like the Deshbandhu Group, or like the company or say Square Foods like this. If they have the same product, I mean, these are very comparable. In that case, you can take the peers and we can take the average multiple of these companies who are my peer companies. And nowadays, finding the peers is very much difficult because the each individual business is different from another individual business because of their product mix, because of the differences in their product mix. In that case, we can rely on the industry or sector index. You can think of this is kind of I would say very polluted definition because this is not reflecting the peers, but some companies might be very close, might be very ideal candidate for peers, but some might be very different. Think of a company like what should I say, Titas Gas. So Titas Gas is purely a natural gas supplying or natural gas distributing company, right? So which companies are the peer companies of this? So you can consider the Kondafuli gas distribution companies a peer company of this. Okay, in that case, you get the peers. But if you look at the DSC classification or Dhaka Stock Exchange classification of the sector, of this kind of companies, fuel and power companies, you will see the power companies are there. The fuel companies are there. The kind of power companies, the DESCO, DPTC, these companies are in the same sector. At the same time, you will see the Podda, Meghna, Jamuna, Eastern Lubricants, these companies are there. Now, if you take the multiple of these companies, what I mentioned with the multiple of theta, it might be a kind of dirty comparison, but sometimes we do not have a good choice. In that case, we need to rely on the multiple coming from this classification of industry. So if you read the financial newspaper, you'll see that every day the sector PE or industry sector PE, as ideally speaking, sector PEs are reported. So each of the sector has different PE. Banking sector has different PE. And in this way, you can compare with the sector PE for your company's PE. The broad market index, the idea is that it's a more comprehensive. You can think of the DSC market overall PE. So say DSC overall PE is 10. So what we do? We take the price of all stocks of listed traded in DSC and divide the price, the market capitalization of the market, and divide the summation of all the earnings of the listed companies to get the market PE. So you can compare our stocks PE, say to 12 with the market PE of 10, and we consider that our stock is relatively overvalued in comparison to market overall PE. So these are the some sources for benchmark. Another alternative choice is that we look at our own company. We look at our own company's history. Say, for example, we have the Scar Pharmaceuticals. This was traded at 10 multiple, 12 multiple, 14 multiple in previous 3 years, year 1, year 2, year 3. In previous 3 years, right now we are in year 4. So we see that, say, for example, we have on an historical average, this stock was trading at 13 multiple. Nowadays, it has 10 multiple right at this moment. Think of this year is current year. And we consider that our stock is relatively undervalued. Relative to what? Relative to its historical average multiple. Okay. So these are some typical sources of benchmark values. And conventionally we use this. Okay. So right now we like to see different versions of the multiples, and we'll be talking about the usefulness and the drawbacks of each of these multiple. So first of all, the price to earnings ratio, very well known to you. We talked about it in earlier classes, but we'll be talking much more in detail in today's class. So first of all, let me explain that why it is a useful multiple and what are the drawbacks of this multiple, and then I will show you the construction of this. So first of all, the EPS is a driver of value. It is the first usefulness of using the price to earnings ratio. So when you make investment in some companies, the primary expectation of you is to see that your company is producing higher and higher EPS. So when you take the EPS in a denominator of a multiple, in that case, you are taking some metric which you are looking for. So in that case, a very expected item. So, and it is widely used across the countries, across the analyst, and most conversated ratio among the analysts. And it is undoubtedly very widely used. If you will be, when you'll be working in the market, you will be finding it very common that your supervisors are or your bosses are talking to each other by saying that this stock is traded at 10 multiple, this stock is traded at 12 PE, or this stock is traded at 5 PE. We expect that this will be traded at 8 PE. Like this, they don't mention the price, they don't mention the earnings, but they mention the price to earnings. So this is a very commonly used multiple. And in empirical research, it has been observed that if you have, say, for example, 100 stocks, 100 stocks are producing different ways, different measures of different. Some stocks are giving very high return, some stocks are very low return. And it has been observed that what are the reasons why some stocks are providing higher return, some stocks are generating very lower return. It has been observed that there is a difference between the price to earnings ratio of these companies. So the stocks which are traded at low PE, they are expected to provide higher return, and the stocks which are traded at lower PE, they are expected to provide higher return. So there is a inverse relation between the PE and the stock return in future. So what are the problems with the price earnings ratio? So we probably mentioned it in one of my earlier classes. So when earnings become zero, or negative, or very small amount of earnings, whatever the reason can be very bad reason, the reason can be very good reason. But in that case, the usefulness of the price to earnings ratio depletes. So you cannot, you know that this is not mathematically defined, right? So if you have a 10 price and you divide the number by earnings, say for example 0, right? If you divide the number by 0, it is not a mathematically defined number, it does not carry any meaning, right? And if the earnings becomes negative, say -5, in that case this price to earnings ratio does not tell you anything. And sometimes the earnings can include some earnings which are transitory in nature. Say for example, you have incurred gain from selling your furniture. So this earnings has been added, the kind of extraordinary earnings. So you are not in a furniture business, you are in a, say for example, making business of steel. So in that case, selling furniture and getting gain, and your earnings has become increased. So this earnings is not a permanent kind of earnings in nature. This earnings will not be repeated in the future. But when you take this earnings number or EPS number and you divide the price by this earnings, this price to earnings ratio is not a kind of reliable, because the earnings include something which is not likely to be permanent. So finding which portion of earnings is permanent, which portion of earnings is transitory is a task, and what analysts need to look for. Analysts need to purify the earnings for filtering the earnings which are permanent, and to separate it out from the earnings which are transitory in nature. And you probably are familiar with the fact that accounting has provided the discretion to the management to manage the earnings. So if you take the earnings of some companies which is managed by the management, in that case, the price, using the price to earnings ratio will not give you some useful meaning. So these are some issues which you need to be careful when using the price to earnings ratio. So you probably can recall that we provided you the two flavors of price to earnings ratio. One is trailing PE, another one is forward PE. So from the term, I mean, these terminologies are very clear. So when it is trailing P, what we do, we take the latest available 12 months earnings. Note it very carefully. When it is trailing PE, in this earnings, what we do, we take the latest available 12 months earnings as the denominator to measure the earnings. So when it is become useful, if we see that the estimate for the future earnings is not available to us for any reason, for whatever the reason, in that case, the trailing PE becomes useful. So sometimes you see the financial newspaper which report the details of the stock market provides a separate column where they provide the trailing PE. So it is primarily trailing PE, not the forward PE. So they take the latest 12-month earnings and divide the current stock market, current stock price by the by this 12-month earnings, and they report the trailing PE to the readers. And another definition, another version of the PE is the forward PE. So from the term, it is very straightforward what it is. The price is same, the current price, but what is the changes? The changes is here. So in the numerator. So in the numerator, what we do, we take the forward PE. We take the forward earnings. So as an analyst, we expect or we estimate the earnings for the next 12 months. You are doing the task right now. You are estimating the earnings for your assigned company. And you expect that your company will report, say, how much earnings in the next 12 months or next year or next entire 4 quarters. So in that case, you take the estimated earnings and you divide the current stock price by the estimated future earnings. Then you get the forward PE. So forward PE is more informative than the trailing PE because the valuation is forward looking. So trailing PE does not reflect what is going to happen in the future, but the forward PE, because you take the future estimate of earnings, that's why the forward PE is more forward looking, and as an analyst, you should prefer the forward PE over the trailing PE. So what are other issues we need to think of when we take the denominator, which is the EPS? This is not very straightforward here. Some might say that the EPS is reported in the income statement, and we take it directly from there, and we divide the current stock market price by the reported EPS, and that is the price to earnings ratio. So as an analyst, you need to think of some issues when you take the EPS. So first of all, you probably are familiar with the basic EPS and the diluted EPS. So diluted EPS is, it is more useful from an analytical perspective to the analyst. That's why the analysts look for the diluted EPS rather than the basic EPS. You probably are aware of the fact that diluted EPS is only available for the companies which have some convertible bonds or convertible preferred stock. So the task has been made easier for the analyst because the companies which have the potential dilution or convertible stocks, in that case, the companies report both the basic EPS and also the diluted EPS. So that is the recommendation we need to follow. This is available. The task is easy. The earnings which is reported by the company, we should think of the filtering the earnings, as I mentioned to you, which are sustainable, which are not a kind of transitory type of earnings. So if you see that your EPS from primary activities are not very high, but the EPS has become high because companies has reported a very huge gain from selling some capital assets, or gain from some capital assets, or has sold some of its segment, and they reported some of those earnings. So and they have reported sales of some products which are not expected to continue in the next year. In that case, we need to purify the EPS to think of that our EPS, or the EPS we are considering, is reflection of the sustainable earnings, or the earnings which are not transitory. And the third issue, the normalized earnings, is the fact that think of the COVID time. So during the COVID time, most of the companies reported, because you can think of that during that time, most of the companies had this kind of difficulties. I mean, and then later they got recovered. Now, if you say, for example, you are right now here, say you are right now here, you are considering the trailing P, the chances that you take the, say, latest 12-month earnings from here, the chances that your EPS will be very low or very poor. And you need to consider that this is not primarily for company specific reason. It might be for cyclical reason. So we need to normalize this level of earnings, or we can skip this portion when we expect the future earnings. In that case, the forward PE might be very well representative, because the trailing PE is, the trailing PE is characterized by some cyclical episode. So we need to aware of this fact, okay? So you know very well that it's a kind of also cycle, and which companies are likely to outperform when the business cycle peaks. And you are also familiar with the fact that which companies are likely to underperform when the business cycle is in a trough. So you need to adjust this when you expect the level of earnings. And another fact is that, the companies with which you are making the comparison might follow different accounting standards. So in that case, we need to make the accounting standards comparable. So we'll be mentioning it later, but one example I like to mention that if some companies follow the IFRS, and if other companies follow the US GAAP, this is very likely the companies which follow the IFRS, they report higher level of net income. And the companies which follow the GAAP, they are likely to report the relatively less net income. So it is primarily caused by the differences in the accounting standards followed by these two companies. So to make the comparison, peer companies or industry companies, we need to think of that the companies with which I'm making the comparison, they are the follower of same accounting method. And right now, this is not a very major issue, because the listed companies follow the same accounting methods. Okay. Same accounting standards, not accounting method, but there are differences in accounting method. So for example, some companies follow the FIFO, some companies follow the LIFO. So ideally speaking, the reported net income is likely to be different because of the practices of these two companies in the inventory valuation measures. So to make the companies comparable, what we need to do, we need to think of the apple to apple comparison so we need to check that if my peer companies follow the FIFO, I need to adjust my company's number, which are reported in LIFO to the FIFO, so that the EPS what I'm taking is comparable to the, the PE what I'm taking to compare with my peer companies are comparable. So let's look at a very simple problem. The idea is that how we apply the, the market-based valuation. We see that we have the subject companies BSRM. This is our subject company. And we have two comparable companies. One is AKS Steel, another one is KSRM. So we have the analyst believes that the price to earnings, price to sales, price to book value per share, these multiples are to be used to value the BSRM. So the relevant data for calculating these multiples are given. And based on this, how can you estimate the value of BSRM? By taking the mean of the multiple of the peer companies. So you see that, let me show you one. It's very straightforward, the price to earnings. Sorry. So for BSRM, what do we see? Their PE is 72/2. 72/2 or 36. But for AKS, this is how much? 45/1.5. Is it 30? For AKS, the price to earnings is 30. Is it? Then for KSRM, it is 24. Now, if we take the average of my peer companies, PE ratio, all of these are PE. We have 54. So average PE is 54 divided by 227, right? So BSRM is relatively trading at overvalued or relatively undervalued compared to its peer companies. What do you think? It is 36. Can you write your answer in comment? Peer companies average PE is 27, but BSRM is trading at 36 PE. So it's very obvious that BSRM is relatively overvalued. So relatively overvalued. And the issue what we need to think of that as long as if you look at or if you talk to any retailer of steel or who sells the steel, they consider these three companies very comparable. They consider that these three companies' products are apple to apple comparison. So their prices are very close to each other. So, and they are, if the companies are in an equal footing, in that case, is very close, very ideal comparison. But if you believe that BSRM $2 earnings, BSRM $2 earnings, or if investors believe that if BSRM $2 earnings is more valuable, more worthy than the same $2 earnings produced by AKS and the KSRM, in that case, you should expect that BSRM should be traded at higher multiple. Okay, so if you believe that BSRM is relatively good company in terms of its governance, in terms of its future outlook, in terms of its overall performance, compared to these companies, though they are peer companies, in that case, it is very obvious to think of that BSRM should be traded at higher multiple. So this is a kind of comparison. Let me proceed. So as I mentioned, that you can compare the price to, I mean, you can compare the multiples with the benchmark values. But another way of making comparison is to compare with the justified multiple. So justified multiple means, from the name, it implies that the multiple what it should have based on its fundamentals. Okay. So first of all, think of forward PE. So if we have the forward is estimate of forward earnings, what we do, we take the current price and we divide this number by future expected earnings. This is our definition of forward PE. But we can, I mean, this is our estimate of forward PE. So for example, we have the, say, for example, forward PE of 10. But the question is with which we will make this comparison. So one way to make this comparison with the benchmarks I mentioned earlier, but another way is to make the comparison with the justified forward PE. So if you see this multiple is greater than the justified forward PE, in that case, you might consider that this is relatively overvalued and otherwise undervalued. So how can we come to the justified forward PE? You probably can recall the popular Gordon growth valuation, right? Dividend discount model, expected dividend for the next period divided by cost of equity minus growth rate. So what we are doing, we are thinking that market is efficient, so the price equals to value. So the price is here, current level of price, and we are keeping it as it is same. Okay. Now what we are doing, we are dividing the current both side by the expected level of earnings. I mean, this is a kind of mathematical derivation to show that it is possible to get the justified forward PE. So if I divide both sides by the next period earnings, or sorry, period means here it is 12-month period, and here R minus G. And does it look like a payout ratio, this portion? If it looks like a payout ratio, dividend payout ratio, okay, and if I assume the retention rate, the amount of earnings which is retained, which is not paid out to the shareholders, this is equal to B. In that case, we can consider this payout ratio is equal to 1 minus B. And we keep the R minus G as it is. In that case, this is the estimate for justified forward PE. So justified forward PE is equal to what? It is equal to what? It is equal to the payout ratio, right? If you have the payout ratio, measure of payout ratio, and we divide this number, you can think of it as your estimated payout ratio from your prior history. And we divide this number by the difference between the cost of equity and the expected terminal growth rate. You get the estimate for what? Justified forward PE. Okay. So next thing we like to see, is it possible to come up with the justified trailing PE? So to get the justified trailing PE, what we are doing, again, we are starting with the valuation, but we are writing the valuation in this way. The current year dividend, we multiply this 1 plus G, the expected growth rate for the next year, and you divide this number by R minus G. You're familiar with this Gordon growth model. So as I mentioned to you, price equals to value. And what can we do? Then we can divide this number by the current level of earnings. And again, we are doing the same thing here. D naught over current level of earnings. We're dividing both sides by current level of earnings, 1 plus G and R minus G. Does it look like the payout ratio? So if it is a payout ratio, what can we do? As I mentioned before you, that B equals to retention rate. So 1 minus B equals to what? 1 minus B equals to payout ratio. And you take the 1 plus G and R minus G as it is. Okay. Now, what do you think? It is a justified trailing P. Why it is justified? Because you are taking something here which are fundamental for the company. Think of the payout ratio. It is a fundamental thing of a company. And G, growth rate, is another fundamental. The return on here, the cost of equity is another fundamental. So you are trying to rearrange the fundamentals of the company to get the estimate of trailing P. That's why it is a justified trailing P. So the way of making comparison is that if your justified trailing P is 12, but your stock is trading at 10 trailing P, in that case, you'll consider that your stock is relatively undervalued. You should take the long position in the stock. Okay. So from this equation, you need to get familiarized with some relation that what do you expect if the expected growth rate is higher? What do you expect? The higher the trailing PE. Okay. The higher the growth rate, the higher the trailing PE. And the higher the retention rate. What I mentioned, B equals to what? The higher the retention rate. What do you expect? If the retention rate is higher, if the retention rate becomes higher, should you expect the higher PE or lower PE? I mean, justified. Okay. So you need to understand this equation and think of these fundamentals again in this definition also. Okay. So as I mentioned to you that there are issues with the price to earnings ratio. So obviously you might ask that, do we have better alternative? Yes, we have some better alternatives. If we see that the problems with the price to earnings ratios are much more, we have to avoid this. In that case, the first alternative we like to offer is that we take the price to book value. So the numerator is very obvious. We're taking the stock price, but which we are taking here, you probably can recall the NAV. Company reports the NAV. Okay, that is the estimate for book value. So that comes from higher asset minus the liabilities divided by number of outstanding common shares. Okay. And that is equal to the estimate of NAV, or that is also estimate for book value. Okay. So whatever you write, that is here. So why it is useful? The price to book value. The primarily for the reasons why the price to earnings ratio is not useful. Okay, you can keep this in your mind to remind you. So first of all, you probably can recall one problem with the EPS was that it can be negative, but the book value is usually positive. It is very common that you will see the book value is usually positive. And compared to EPS earnings number, the fluctuation of the book value is very unlikely. So in that case, if you see the EPS, you probably can recall the normalized earnings issue. So EPS can be fluctuating for the cyclical issues for steel companies, for auto companies. In that case, for these companies, which can be a good alternative, the price to book value can be a good alternative. Okay. And for financial firms, most of their assets are liquid assets. Most of their liabilities are also liquid liabilities. So it is very likely that their assets and liabilities which are presented in the balance sheet mostly reflect the market values. So if they mostly reflect the market values, you get the book value, which is most representative of the market fundamentals, or most of the, market-based valuation, market valuation, unlike the other companies, say manufacturing companies, their assets and liabilities are not as liquid as the financial firms. So in that case, for financial firms, the price to book value is more meaningful. Okay. And it is also be very useful for the companies which are likely to cease their operation. And it is all, again, in empirical research, it has been found that if you take the 100 companies, they are varying in return. In that case, it has been observed that the stocks which have high price to book values, note it very carefully, the stocks which have high price to book value, they are likely to produce lower return. And the stocks which have low price to book value, they are likely to produce higher return. Can you recall the value premium from the Pharma Friends 3 factor? So one factor was the value premium, right? So how they consider the value premium? They consider the value in this way. They take the book value over the current market price, and the stocks which have low in this number, they consider they are relatively undervalued, and they found that these are likely to outperform in the future, and the opposite is true. Okay. And what are the problems with the price to book value multiple? We mentioned the usefulness earlier. So the problem is that some companies are very well known to you and very valuable to you. But the reason for which these companies are very well known to you, very valuable to you, are for the reason that they have some CEOs like the Apple CEO or like the Tesla CEO, like this. So Apple's balance sheet or the Tesla's balance sheet does not recognize the value of their CEO in their balance sheet. So this book value is not a reflection of the valuables what the company has. Okay. And sometimes the asset level of the company varies for some good reason. You probably can recall or familiar with the Dell. So Dell uses the, they do not have inventory. What they do, they take the order from the customers directly and they place it to the suppliers on that time, and they make the assembly on the right time, and they have less pile up of the inventory. So in that case, the level of the inventory or the level of asset is likely to be lower for the company like Dell because of the strategic reason. But you will consider that Dell is relatively overvalued. Sorry, relatively overvalued, because you'll find the book value of the book value of the Dell very low compared to other companies. That will consider it relatively overvalued. But this is happening for some strategic reason. And again, due to accounting practices, there are issue of using this multiple. You probably can recall we recommended to expense the goodwill. Entire goodwill will be expensed. It will not be shown. Okay. So in that case, some companies might not do this, and there are some issues with kind of intangible assets, which are accounting issues. For this reason, the comparing the price to book value might become complicated, and uh, firm might have assets of different ages, and invested uh, some have invested in new assets. They have a very huge collection of assets. Some have very less collection of assets. So due to their utilization of assets, there is a likely that the price to book value will be different for a strategic reason. And again, another issue, which is not the issue in our country because of the absence of the stock repurchase, but the long story short, a stock repurchases reduces the value of the equity. So if it reduces the value of the equity, the book value is likely to be negative. So it is a very continuous process in the developed market. The stock repurchases are happening. So stock repurchases are reducing your book value of equity. Now, if you compare it, if you take the price here, so what is likely to see that the price to book value is relatively high, but it is happening not for some good reason, but it is happening for the issue of the repurchase. Okay. So in addition to this, we have to be aware of some issues to when we'll be using the price to book value. So first of all, as I mentioned, if we have the intangibles to make the comparison apple to apple, we need to exclude the intangible assets from the balance sheet so that the companies become comparable. You probably can recall one question was there in the midterm one, which was less familiar to you. But later it was mentioned to you that analysts, what they do, they exclude the intangibles like the goodwill to make the companies comparable and also to reduce the chance of reduce the chance of overestimating the value of assets for inclusion of goodwill. And the inventory accounting, as I mentioned, the FIFO and LIFO, we need to make adjustment for this because it affects the inventory valuation because inventory is in the balance sheet also. So if you see two companies are following two accounting methods for inventory valuation, we need to make the valuation in same method so that the comparison become apple to apple. Some companies might have significant off balance sheet items, primarily the banks and financial institutions. In that case, the adjustment for off balance sheet items become necessary. And sometimes the fair value of the assets and liabilities are issue. The idea is that for financial assets, you probably can recall I mentioned it earlier, the held for trading and available for sale securities are to be reflected in the fair value. But other assets, non-financial assets are recorded at primarily historical cost using the conservative method. So that's why the comparison might not be apple to apple. We need to try our best to make the comparison fair comparison so that the comparison is apple to apple. So justified price to book value. The idea is very simple, but you probably can recall. I showed you this derivation in the previous class in the residual income valuation. Okay. So let me show you this again. So let me start with forward PE. Remember with which I'm starting. I'm starting for calculating the justified price to book value by what? By taking the forward PE. So can you recall what we wrote the justified forward PE? 1 minus B over R minus G. So can I replace these earnings in this way, that I have the beginning book value of equity and I'm multiplying it by return on equity, and that is reflecting what? The earnings estimate, right? And here 1 minus B R minus G. Now you see that if I divide both sides by ROE, right? Sorry, I mean, if I divide both sides, okay. This is not a kind of divide, this is a kind of multiplication. I'm taking ROE, I'm multiplying this here, ROE. Okay, let me write in this way. B multiplied by ROE. And here B equals to what? This B. I mean, yeah, B equals to, can you recall the B? Retention rate. Okay. So what do we see? ROE is here, but you probably can recall from the analysis of financial investment that the retention rate multiplied by the return on equity is an estimate for what? Is an estimate for growth rate. So look at here, it is a retention rate, it is a return on equity. Can I write here growth rate? So I'm replacing it by here, R minus G. So justified price to book value can be estimated by what? By taking the difference between the return on equity and the growth rate and divide the difference by the difference between the cost of equity minus growth rate. Okay. And another way of looking at the price to book value is in this way. You probably can recall that we estimate the valuation in residual income, that we start with book value and we take the present value of all residual income. You probably can recall this from your previous class. I'm not writing the entire definition, but ideally speaking, this is like this. So if I divide or if I consider that this is equal, or valuation equals to price, and I keep it as it is like this, and if I divide this number by book value, this becomes 1, and this becomes present value of residual future residual earnings, and you divide this number by book value. So you can think of the price to book value also in this way. So you see that if the company does not have any future, what will happen to this term? If a company does not have any future, what will happen to this term? Look at this term and think of it and write the response in chat. If the company does not have any growth in future, I mean, the company's future residual incomes become 0. What will happen to this term? This term will become 0. So this term will become 0. In that case, the price to book value, ideally speaking, what it should have? Ideally speaking, the price to book value should be equal to 1. If the future of the company is lackluster, the company has no future. But why do we see that the companies have price to book value greater than 1? So the ideal answer is that the companies have future. The companies have bright future in the forward time. So that's why it is to be greater than 1. So this one is, you see the construction here. We divide both sides by what? This book value. So we need to think of in this way. For what reason this is likely to be higher, for what reason this is likely to be lower. And another flavor, you probably also have recognized the problems of the price to book value by this time. So think of another alternative, that is the price to sales. So the usefulness of the price to sales comes from the drawbacks of the price to earnings and the price to book value. So compared to earnings and the book value, sales are very difficult to manipulate. Because managers can manipulate the EPS because he has different avenues by say, for example, underestimating expenses like this. But think of the sales. You start the income statement by sales. So I'm not nullifying the possibility of manipulating sales, but I'm saying that it is less easier to make the manipulation in the sales because the managers need to start with sales. Okay. And the problem of -0, this do not appear here because the sales are always positive. And it is also appropriate for the companies which are kind of for all type of companies, I would say, wherever the company belongs, the mature stage, cyclical or distress stage, there is no issue of the I mean abnormality of the sales. So say you can think of the sales, and compared to the price to earnings, price to sales is more stable. Again, it has been observed that when you compare the company's return or stocks return, the stocks which are likely to have low price to sales ratio, they are likely to have higher return in the future, and the opposite is true. So they have the potential to explain the stock return. So as an analyst, you need to at the same time think of what are the problems associated with the price to sales ratio. So the problems are that a company reports high level of sales does not automatically translate to high level of earnings and the cash flows. You probably can recall I provided you a number of examples how companies inflate the sales or aggressively recognize the sales. So when company does these practices, this is unlikely that this higher sales will give you the higher earnings and the cash flows. And so we need to be careful of this. And what are other problems? Problems are that we probably made this point earlier. I don't know whether I did this. When you take the price to earnings, the price is of a stock price and this is of shareholders. And this earnings is to be distributed to the shareholders. So these are consistent, numerator and the denominator consistent. But if you take the price here in the numerator, but you divide this number by sales, and this price is stock price, shareholders, but this sales is contributed by both shareholders and the debt holders. So this numerator and the denominator are not consistent. So the problem is here. That's why you're recognizing this. And the companies, you probably can recall the companies, the Apple's valuation, their cost of goods sold is lower relative to the price they charge. But if you can think of other companies like the Xiaomi, their cost of goods sold is relatively higher, the higher proportion of their sales. So obviously, the companies are different in terms of the costing they have. So when you compare the two companies, say Apple and the Xiaomi, just by taking the price and sales of Apple and the price of sales of Xiaomi, in that case, the comparison is not a kind of apple to apple because the companies are different in terms of the differences in their cost structure, right? And another issue is that accounting practices, sometimes companies might follow the aggressive revenue recognition. You probably can recall the practices I mentioned to you, bill and hold, channel stuffing, like this. I asked you to look at this. So these practices can manipulate the sales. So in that case, this comparison becomes difficult. Now, what we are doing here, you are trying to see that is it possible to come to the justified price to sales multiple. So the answer is that it is again possible. So for justified price to sales multiple, what we are doing, we are starting with justified trailing PE. Can you recall justified trailing PE, what I wrote earlier? 1 minus B, sorry, 1 plus G, R minus G. Now, if I divide both sides by earnings, what happened? So not divide. I mean, if we multiply both sides, it becomes earnings here, 1 minus B, 1 plus G, and here R minus G. Now, if I add the sales, remember, what is it, this sales? It is a sales per share because the price is per share price. So sales is per share. You take the entire sales and you divide this number by total number of outstanding common share. You divide this number, entire term by sales. And we divide this by sales. And here it is 1 minus B, 1 plus G, R minus G. So what do you see here? This is a justified price to sales. Does it look like the net profit margin, this portion? What is it? It is a payout ratio. What is it? It is a growth rate. And what is it? The difference between the cost of equity and the growth rate. Again, we can think of the growth rate in this way, as I showed you earlier, retention rate multiplied by return on equity. Think of this question think of this understanding very carefully because there is a chance of testability. There's a chance of testing your knowledge from understanding this. So this G, what I'm writing here, this G can be written in this entire term. How? You probably can recall this definition of ROE from the DuPont. Now, if you replace the entire big term here in the G and also here in the G, you can think of what is likely to happen for the justified price to sales when any of these variables is likely to go up. Okay. Now, if I ask you, just think of the G. If the G goes up, the price to sales goes up. Okay. Now, if instead of the G, I mention if the company's, I would say, asset turnover goes up. Is it the asset turnover, right? And this is the asset turnover. So if the company's asset turnover goes up, what will happen to the price to sales ratio, justified price to sales ratio? So you can expect that justified price to sales ratio is likely to be higher. At the same time, you can think of the leverage. At the same time, you can think of the profit margin. If the company's profit margin goes up, you expect what? You expect the price to sales ratio is likely to go up. Okay. So you already have seen what are the problems with also the price to sales ratio. Do we have the another alternative? We have the last alternative in terms of the stock price. That is the price to cash flow. So again, you can think of the usefulness of the price to cash flows if you understand the problems with other multiples. So it's a very obvious that cash flow is very unlikely to be manipulated, and compared to earnings, it is more stable. And when you rely on the cash flows instead of the reported earnings, you are more concerned about the quality of the earnings. And again, it has also been found that the differences in the stock return can be explained by the differences in the price to cash flows in the empirical research. So there are several drawbacks when we use the price to cash flows, because the cash flow has number of definitions. All definitions are not the appropriate measure. From your CID, you probably have looked at one of the definition of the cash flow can be written in this way: net income plus non-cash charges. So you see that this definition is incomplete because you do not consider the investment in working capital, right? And if you think of that FCFE, free cash flow to equity, is more complete definition of the cash flow, it might also become a source of problem, because there are chance that FCFE is very volatile. FCFE becomes negative, so that your multiple becomes meaningless. Okay. And because the analysts are very concerned about the cash flows, managers have become skilled that because we will be tested by the cash flows we report, so let's try to manage the cash flows. In that case, the usefulness of the cash flow the multiples based on the cash flows becomes less useful. Okay, so these are the realities what are happening. So these are the definitions what have I mentioned earlier, the characteristics. But another definition of the cash flows is the EBITDA. But if you think of the four cash flows, which is more meaningful to you, or which is more, which is more valuable to you, can you write in your chat box? If you have these four definition of cash flows, one is net income plus non-cash charges. Another one is cash flows from operations from a statement of cash flows. Another one is free cash flow to equity, you know the estimate. And the one is earnings before interest, taxes, depreciation, and amortization. So all of these have different characteristics. But I would say all of these have usefulness and the problems, but to the analyst, FCF is more valuable. And I would like you to see the details of each of this from your text to make you feel comfortable with this definition of the cash flows. Okay. Now, is it possible to get the justified price to cash flow ratios? So the answer is yes. If we take the constant growth model, if we have the current estimate of the FCFE, and we take the 1 plus growth rate, and we divide this number by the difference between the cost of equity and the growth rate, and we can think of the value like this. Okay. So say, for example, by calculating this, you have got 200. In this estimate, think of that you have the FCFE 0 estimate of 20. Now, what can we do to get the justified price to cash flow ratio? We can think of the value equals to price, and we divide this number by FCFE 0. So what estimate of the price we have got? 200. And what calculation we did for FCFE 0? That is 20. In that case, our conclusion for justified price to FCFE is 10. Okay. So what I want you to do, you look at the text, you will see some examples covering this idea. So you will see that how this calculation becomes more useful. So if you see the companies are trading at, say, this comes from the fundamental, okay? If the company's current price to FCFE is, say, 6, but your expectation for justified price to cash flow is 10, you will consider that this stock is relatively undervalued in terms of the justified price to cash flows, okay? Now, another definition or another classification of the multiple is with regard to the enterprise value. You probably can recall the issue with the price to sales was problematic because the sales was contributed by both equity holders and the debt holders. Numerator and the denominator are not consistent. So what can you do? Instead of taking the, price to sales, we can think of the enterprise value. You are familiar with the enterprise value. This is the summation of, this is the reflection of the entire value of the firm, value of the sum of value of equity holders, sum of value of net debt. Net debt equals to what? The long-term debt minus the, long-term debt plus short-term debt minus the cash balances. So in summation, this reflects the enterprise value. And if we divide this number by sales, in that case, it becomes apple to apple. The consistent, because the enterprise value is entire firm, sales is of entire firm. So, enterprise value based multiple becomes useful for this reason, as I mentioned to you. And it is also useful because it is always positive. The problem is that sometimes, okay, we are taking the enterprise value for definition of cash flow. If we take the EBITDA, what are the problems? Note that when you take the EBITDA, in that case, we are ignoring the differences between the capital structure. So that's why it is apple to apple comparison. But the problem is that because it does not consider the, other cash outflow consequences. That's why if we take this estimate, it is likely to inflate the cash flow. So that's why the FCFE is taken. But FCFE is the cash flow to the equity holders. But enterprise value is the entire firm value. So in that case, more meaningful might be if we take the FCFF. Okay, that's why we are saying what FCFF is more strongly grounded. Okay. Now, multiples have given the opportunity to make the comparison across the countries. This is not the only way that we compare the companies across the, within the market or within the economy. With the help of multiple, we can compare the stocks across the countries. So you say, for example, UK has a Leica operator or GiveGov, this kind of mobile telecommunication service providing companies. So you can compare the multiple of GP and the Robi with these companies, because it's a multiple. Currency denomination is not an issue. But when you go for making the comparison, you will have to find some issues. So what are those issues? So the issues are that, say, for example, as I mentioned, the US GAAP, the companies who follows the US GAAP, they are likely to report lower net income. But the companies who follow the IFRS, they are likely to report higher net income. The companies which follow the US GAAP, they are likely to report higher return on equity. And the companies which follow the IFRS, they are likely to report lower return on equity. In that case, the price to earnings, the price to book value, the price to sales, these are likely to be these companies are likely to be manipulated based on, problematic based on these ratios. So in empirical research, it has been found that unlike these ratios, what I mentioned, these ratios are more comparable. Which ratios? The price to cash flow from operations, and the price to free cash flow to equity. These are more comparable, but these are least comparable. And another fact you need to consider that, say, for example, as I mentioned about the companies like GIFGA from the United Kingdom. So the inflation what is faced by the UK right now is more than, say, 15% or 20%. So compared to our inflation, 8 or 10% in this range, their inflation is very high. So we need to think of these inflation issues also. So what are the general relation of the influence of the inflation on this multiple? So you need to check the mechanism, how these multiples are likely to be affected for the inflation. But long story short, if your economy faces higher inflation, the justified price multiple, what you are estimating, are likely to be lower compared to another economy where the inflation is lower. Okay, so higher inflation reduces the justified price multiple. And now think of two companies, Apple and the Xiaomi. Which companies have more bargain against the customer? Between the Apple and the Xiaomi, which companies have more dominance against the customer? Can you write your answer in the chat box? So Apple has more dominance against its customer. So if US economy faces higher inflation, it is or the countries where the Apple manufactures its products, it faces higher inflation. What Apple can do, Apple can pass through the inflation to the shoulder of customer. If Apple can pass through the burden of inflation to the customer, it is very likely to see that Apple's justified price multiple becomes higher. But Xiaomi, which has less bargain against its customer, you will see that because they'll not be able to transfer the burden of the higher burden of inflation to the shoulder of the customer, you'll see that the justified price multiple, if you calculate for Xiaomi, it is likely to be lower. Okay, so Xiaomi should be traded at a lower price compared to Apple. So you need to think of these issues when you make the comparison across the countries for the companies based on the multiples. So this is the end of today's class.